FIL was around $1.4. Within 2 days, it pushed above $3.8. Then it rolled over, drifted lower, and even traded below the starting level. That's the Wyckoff idea in plain English. Massive effort, weak result. Not proof of a conspiracy, just a market fact. The rally ran into real supply strong enough to absorb the bids. So what? If you want to understand FIL's price behavior, you track where that supply comes from, not just the candles. When a market prints huge volume and can't hold gains, there are only a few candidates. New issuance becoming liquid, scheduled unlocks, or older inventory rotating out into a rare liquidity window. We can't identify sellers perfectly from price alone, but we can map the supply channels and ask which one is still alive today. First, FIL is not ETH. ETH has no fixed max supply. FIL does, a hard cap starting at 2 billion. So the right way to think about FIL is fixed total supply, but changing distribution and liquidity. Early investors are 10%. The longest vesting was 3 years. So by 2025, that bucket is fully vested, already in the float. They can still sell, of course, but there's no new unlock flow accelerating today. So what? Investor selling is mainly rotation. It creates volatility, but it's not a fresh dilution shock. This tranche vests linearly over 6 years. By the estimate, it's roughly 85% released, and it completes around OCT 2026. So yes, it can still add supply, but the marginal flow is increasingly the tail, known, finite, measurable. Around $1 I'm not overly worried about old money driving the next major leg by itself, not because they can't sell, but because their incremental flow is not suddenly rising. Once you remove those as the main marginal drivers, the big bucket left is clear. Minor rewards, 70%. This is where the market usually jumps to one conclusion. Miners are an infinite money printer. They're the biggest dilution threat. Let's tighten that. Miners are a dilution channel. Yes, but infinite printer is sloppy. The design is more conditional than people assume. Miner rewards split into mining reserve, mining allocation, storage mining rewards. Mining reserve is about 21.4% of miner rewards. Think of it like a policy reserve. Without a major community proposal, it doesn't just mint automatically. From the chart, over 5 years, mining reserve released about 17.1 mem in FIL, roughly 2% of circulating supply. So what? Medium term, this bucket is not the main sell pressure engine. Now the real one. Mining allocation is about 78.6% of miner rewards. This is the channel you track if you care about sustained supply. Inside mining allocation, simple minting 30%, baseline minting 70%. Simple minting is paid out on schedule, basically miner's base salary. It follows a 6-year halving-like rhythm. Every 6 years, the base issuance rate drops to half. So around OCT 2026, FIL completes its first structural halving on that component. Even the always-on part has a built-in slowdown. Baseline minting is the bigger piece, and it's like a KPI bonus. The target is roughly, network power grows about 100% per year. If the network meets or beats the target, baseline rewards release in full. If it falls short, rewards are withheld and deferred until performance catches up. Baseline is conditional issuance. It can tighten or loosen supply depending on network growth. Back to the chart. By end of 2025, the KPI target implies total power around 90 to 100 EIB, but actual power has been far below that. Flat, even down at times. So the implication is mainnet has been live for 5.2 years, but baseline progress looks more like year 3.3 of the target path. And the rough estimate suggests at least 100 memos FIL that could have entered the market was effectively blocked because the KPI wasn't met. The market is only half right. Miners are a dilution channel, yes, but infinite printer ignores that baseline can stall when growth stalls. Right now, burn hasn't created true supply deflation. Its main effect is cost. It reduces network expenses and helps keep operations cheaper. That helps explain early November behavior. Even at depressed prices, miners may still need to sell to operate. The data suggests about 58% of today's circulation comes from early investors plus team foundation unlocks. The good news, that roughly 600 men historical release is close to the end. The biggest historical overhang may already be behind us. Miners account for about 42% of circulation. About 11% of that was staked back, meaning roughly 63% flowed into the market. Historically, when costs bite, miners sell most of what they earn, and that's why this channel matters for price. So the real question becomes, between old inventory and miner supply, which one is still the marginal seller? For short cycle pricing, the 2B cap is not the right denominator. What matters is true circulating FIL, about 800 mem today. Miner selling is short-term pain. Low prices suppress new power growth, reduce new staking, and force some miners out, which can reduce new supply later. But a large pool of unlocked inventory is a long-term ceiling if real demand isn't strong enough. If demand doesn't absorb circulation, the market digests supply the only way it can: lower prices and time. In 2021-2022, power grew fast and KPI bonus share stayed above 70%, a build-out phase. In 2023-2025, power growth slowed and went flat, baseline rewards fell, and KPI share dropped quickly. So Filecoin is in what you call stage 1.5, from store data to earn rewards to store data because it's actually needed. In a true stage 2, you want real commercial demand. But today, a lot of storage still follows incentives more than organic demand. So the NOV 6 to 8 event wasn't a mystery. It was a stress test. It showed that when liquidity appears, FIL meets it with supply, and the most durable source is the miner reward channel, especially the conditional baseline component. Next, we'll go deeper into the ecosystem side, how Filecoin coordinates this large circulating supply with miner incentives, and what role Glyph could play. If you want that next part, keep following. I'm TQ. See you next time.